Well, hello there, everyone. Welcome to another edition of Tip Tuesday. Our topic for this morning is what drives the market. If you've been watching recently, you might be thinking, who knows? It's just kind of a wild, wild west out there. It's just no real direction, just what's going on. And the reality is, in spite of being in a bear market, we've been in an uptrend for the past basically month to 6 weeks. And so we've been in what looks like at least a recovery. Some stocks have already recovered substantially when you look at it from a percentage perspective. 25. I've seen some as high as 40% from their recent lows just from June of this year. So we're in the midst of at least an uptrend. It's actually broken out of resistance. And that's probably very strange to plenty of you who understand a little history and a little economics. So there have been some things that have been driving the market, and they're actually driving it the wrong way, at least based on historical precedents. So historically, when the Fed has raised interest rates, it has had a negative impact on the market. It's driven people into what they call safer assets so that they can go out there and get, bonds or treasuries at higher rates. And it's called a safer investment, less risky than the market. But that's historical. And that's not really happening right now. In fact, what we saw is a 0.75 basis rate hike recently. And rather than really driving the market down as you would expect a move that big would, the market actually moved up. Why was that? This has to do with one of the other factors we're going to talk about today is what if we have bad news, but it's not as bad as we thought it might be? So one of the things now, a 0.75 basis point is like one of the biggest moves, in a couple of decades, I believe. So it should have driven the market down. It absolutely should have, and we should have seen a really negative and quick response to that. We didn't. Why? Because there was some thought out there that the Fed could go as high as 1 basis point. So it's like a few weeks ago, Netflix lost 1 million subscribers. Well, you would think that's going to tank their stock substantially. And the reality is it did initially. And then you started seeing news articles like, well, losing a million subscribers isn't bad as it seems because we really thought you might lose 2 million. I'm like, wow, you know what? Losing 1 million people at however much they're paying a month is still a really big deal. I don't care if you thought you were going to lose 2 million. Like, that's still 1 million people that are not paying for your service anymore. And that means that more could be dropping in the future, depending on how bad things get economically. But that's kind of how this thing works. So when you kind of start to wonder, well, what's moving the market? We're seeing some bad news. We entered into a recession. So historically, I know we're trying to redefine terms now, but what has created a recession? It's two back to back, so two negative GDP quarters in a row, and that's basically what we've had now. The first 2 quarters of this year. Now, I don't think that's surprising to anybody. And that's actually one of the things that was floated out there. You would have thought, oh, well, once we get the real news that we're in a real recession, the market's going to tank again. It'll see the next big move down. And in fact, we saw the opposite. People are like, oh, yeah, okay, that's what we thought. And then it just kept going up, which is a really strange thing. And I've been talking about this for a couple of months now, that it feels like we're living in bizarro world. Where things that ought to be moving the market down are simply not having that effect. So what are some of the things that do tend to impact the market the most? I would say one is a chart. So if you don't have access to some charting software, whether that's Charts by Tradeway or Telechart or Thinkorswim's stuff, or something like that, you need the ability to understand how patterns work. I think we do a really good job of teaching that here at Tradeway, but understanding that there are patterns, and those patterns tend to be predictable, repeatable, and reliable. And so, like, most of the time you can look back, and even if it doesn't make sense at the time, you can kind of look back and say, oh, in retrospect, I can kind of see why this was doing that. And then sometimes we see it live. You can see it even to the point of just stopping at a particular price point. You go, wow, that's really cool. So it stops right at a resistance line, or it turns right at a support line. And we've seen that over and over and over again. So that's one thing that drives the market, is just technical analysis. The other thing that drives the market is fundamentally driven, and this is stocks, actual companies. Don't ever forget that the actual stock market is made up of actual companies that are either producing better results than expected or worse results than expected. So right now we're in the heart of what we call earnings season. So there's about a 3-week stretch here where thousands upon thousands upon thousands of stocks or companies are going to report their earnings. And so, what does that look like exactly? Well, first off, it's a SEC mandated proposal that they have to put out, and it's based on really three things. So, one, it's their actual numbers, so their actual numbers from the previous quarter. And then it's also includes their projection for the next quarter. So, they can say, well, things aren't, you know, as bad moving forward. But yeah, things were pretty terrible, like way worse than we thought last quarter. But maybe we see the next quarter as being good. So you have the actual numbers. Then they're going to have to give some details, some updates on what their plans are and where they're going. So those are the three facets. So what happened in the last quarter? What do we see happening potentially in the next quarter? And what are our plans? So those are the three facets. And so sometimes you can get a negative report from last quarter, but now you kind of have that question. So, okay, we didn't do as well as we thought last quarter, but we think we're going to see an uptick next quarter. So as an investor, what do you want to, kind of rely on? Do you want to say, well, that last report was worse than we thought, so we actually, your company's a little overvalued, we need to be selling? Or do you look at it and say, well, okay, so you were bad, but now you think you're going to be better, we should go with that, and we should actually be buying? That makes the earnings reports very, very tricky. You don't really know how the professionals are going to respond. And so we always encourage people, don't stay in your trade through an earnings report, because it's very unpredictable. The stock, it often creates a gap, and that's space between where it closed and where it opened. So one day to the next. Now it could gap up, or it could gap down, and it could be, anywhere from a few percentage points to sometimes 20, 30. I've seen some of them, gap as much as 40% after an earnings report. So that's going to be something that drives the market. Of course, then you have economic factors. So are we still in a recession? Is the CPI, the core price, consumer price index, is that still rising? So in other words, are people still paying more and more and more for the cost of goods? If that's the case, then at some point that's going to catch up to all of us. So assuming that you're getting paid the same amount, but everything costs more, at some point you got to figure out, well, I'm not making more money. So how am I going to pay for more stuff, or am I going to cut back on buying stuff? And so if enough people cut back on buying, then of course they're just going to have inventory sitting on the shelves, and they don't want inventory sitting on the shelves. So eventually you'll see a reduction in the prices. We haven't really seen that yet. The Fed is trying to encourage that. So we had a housing market that was just skyrocketing. And we hit the peak, and now we're coming off the peak a little bit. And we're starting to see houses sit on the market a little bit longer. One of the things that I would be watching for, just as far as market tone is concerned, is what's going to happen with debt. So are people, are they putting more on their credit cards, and with these higher interest rates, are they going to be able to pay those off? Or are people going to get in a situation where we start to see, what? I can't afford this house at this payment. I can't, cars have just been ridiculously expensive for the past couple of years. Supply issue, whatever. They're just ridiculously expensive. So how many people are going to be able to make those car payments when everything else around them is more expensive? Are they going to choose a car? Are they going to choose food if they have to choose that? That kind of thing. Are we going to get to a place where we see that kind of really decision making happening in homes? If so, then that's going to have a direct impact on the economy, particularly if it affects enough people. How do the banks respond? Charging more? Are they going to be able to loan as much money? Are people going to be looking for loans? What is that going to look like? So all those things are going to impact the market. And then just we have professional investors. We don't want to ever lose sight of those people. So these are people out there that are making money off of either buying and or selling. I think sometimes it's easy for us to forget or not really realize they can make money both ways. So they can buy the stock in anticipation that it's going up, or they can sell or short the stock and either drive it down or anticipate that it drops and make money as it drops. So these professional, investors are out there kind of creating, in a sense, market movement. And so we want to be aligned with what they're doing, even if what we see them doing doesn't really line up with what we think they should be doing. We really want to follow them. I talk about an illustration. Firemen are paid to go into burning buildings. But if you're inside a building and you're sitting there and you hear your alarm going off, it's like, and you're like, it's not time for me to get up. Well, if the firemen are in the building, it's time for you to get up. And if you see them running out of the building, that's your opportunity to try to run faster than them, because that thing is dropping. So you can think, oh, I'm going to stay in this market. It's still going to be good. But if the professionals are moving out, if the professionals are selling, then we need to be following them, because ultimately they are going to drive the market up or down. So there are a number of factors that all work together to either drive the market up or down. And so one of the things that we need to keep in mind, and this will be our final thought, is projections. So where do the professionals see the market going? So we know that we are in a recession. Will there be a third quarter, or will there be a recovery? Will it actually, next quarter, will the GDP actually be in a positive number? And so what the professionals are also doing is they're looking forward. So they're not looking at necessarily where we are now always. They're also projecting where we will be. And if things are going to be getting better, then they're going to enter the market while things are still bad, in anticipation that as they get better and the earnings reports are better and the stock prices go up, then they'll be capitalizing on that move as it moves up. So remember that the professionals are trading, they're active, they're buying, they're selling, they are looking at news, but it's not always in the same way that we might see the news. So bad news could actually be twisted into good news if it's not as bad as they thought it might be. And then where are we going? Where are we going long term? Where are we going short term? That's going to affect their desire to buy and sell. And then, of course, we have the technical element as well. Where are we in the confines of the chart? Is it time to be buying? Is it time to be selling? Those are going to impact their decisions. And then, of course, the individual stocks. Is it time to buy or sell based on technical analysis there? So a number of factors that influence the market that are going to give us a sense of where it's going. And these are a few of those things that I wanted to highlight for you today. So thanks for being with us this morning. And that concludes today's Tip Tuesday.